A very good afternoon, good morning. Welcome to HYCM's live market analysis with myself, Giles Coughlin, the Chief Currency Analyst. It's very good to be speaking to you today. Looking forward to explaining what's going on. We see markets in a risk-off setting, and I'm just going to run through with you why that is and some of the possible explanations and what we need to look at. Don't forget, as we go through the different instruments, different trading opportunities, that any entries, exits we talk about, it's not a trading signal service. Instead, this is an educational service. The idea is you look at my understanding of the market, someone with a professional trading background, and then that helps you make decisions for your trading. So that's the whole idea. These are the key topics we're going to be looking at today. We're looking at gold. Gold's at a very interesting point. I'll explain what gold's main drivers are so you can be on top of what's moving gold up and what's moving gold down. We'll also be looking at the ECB interest rate decision, very important decision coming this week. I'll explain to you why it's important and what we can expect. Also be looking at the New Zealand dollar. Last week's inflation data.
We're watching FX at a number of key levels. Next up on our radar, dollar yen at 1.
So coming in very high, the New Zealand CPI, highest reading in 19 quarters. So that's nearly 5 years highest reading. I'll explain that. Looking at the medium-term outlook for the dollar and the pound Australian dollar, this has been a long-term buy position that I've been in, and I'll be looking at that. I had a question today, is it still a good idea to buy? So we'll be looking at the pound Australian dollar. And we'll also be learning what we learned from the last Bank of Canada decision for the Canadian dollar. So plenty to be looking at. Don't forget, please use the question and answer panel when you're using this. It will help your enjoyment and benefit of this webinar if you ask questions. And I will ask questions either as I go along, and I will answer every question at the end of the webinar. So as I say, the only silly question is a question that you haven't asked. So without further ado, we'll go over to the main screens and we'll start looking what's going on. Now, the market is in a clear risk-off setting. Now, let me explain to you how to recognize a risk-off setting. So risk-off setting is when you see commodities lower. So here we see silver, copper, WTI crude all lower. Now let me explain to you. The reason crude complexes are lower is because OPEC have met and they've agreed to phase out by September next year the production cuts. So the production cuts that OPEC had been using was what's supporting oil. Now the chances of oil going to $100 per barrel are a lot less because OPEC Plus are saying, well, that's it. We're going to phase out the production cuts, and eventually the full supply is going to come back into the market. Now, in the near term, I'm expecting a range between maybe the 68 and 70 region. So if we see any drops down low into the 68, I will expect initial buyers on a drop, but this is a crucial thing, probably expecting it a little bit lower now, those buyers, maybe around that 67, 66 region. And also, I am not necessarily expecting this to return and test those $77, $80 highs. They could do, but the outlook now is a lot less more secure for oil because OPEC Plus are bringing production. Remember, more supply in the oil means there's more oil to be used. That means the prices goes lower. Okay, so that's what's happening with crude complex. Now, the reason commodities are dropping is because the dollar is strong. So the dollar is seeing some safe haven flows. That's resulting in the pound, euro, Aussie, New Zealand, US dollar all pushing lower. Dollar CAD moving higher. Now, the reason dollar CAD's moving higher is Canadian dollar is a petrocurrency. So whenever you see oil prices fall, that also puts pressure on the Canadian dollar. So that's what's happening there. Now, let's look at yields. When you have risk-off markets, you have bids into bonds. Now, when bonds are being bought, the yields fall. Okay, so this is the yields of the US, German, Canadian, New Zealand. So when these bonds are being bought, it's because investors, they're looking for a safe place to put their money. Now, where is a relatively safe place? Well, a government bond. Why? governments are very unlikely to go bankrupt. So the US treasuries, so that's the US government bonds, are considered the most secure investment in the whole wide world. So seeing bids into these bonds means that investors are feeling nervous. Okay, so we've got commodities lower, we've got the dollar higher, we've got bond prices being bid, yields lower. We also have equity markets falling lower. Now, in the big scheme of things, you just look here. Now, is this really a massive shift in equity markets? No. Equity markets are falling, but there isn't any major necessary catalyst for this. Yes, equity markets have been very high. Is it rising virus cases? Is that concerning equity markets? Is it US-China tensions? So there is a number of different sort of ideas knocking around what is actually driving these markets lower. And what the important thing to be aware of is that, yes, equity markets are falling lower, and in a sense that, you know, that is it's a negative drag on equity markets, but there isn't like an obvious and very, very strong catalyst that is driving that. It's not like there's an obvious reason. Is it US-China tensions? Not necessarily. Is it rising virus cases? Well, the vaccine should encourage things. At the moment, this is just a pullback. Now, having said that, we don't just buy in any area, but you can see here FTSE 100, look, that's fallen into an area of support. So I would expect medium-term buyers to step in at this level. Looking at the S&P 500, you can see that's a medium-term level of support. We'll expect buyers to be stepping in here at this level. Now, the beauty of here is that stops in the S&P 500 can be run lower for 200. And in the FTSE 100, you can see that stops can be nicely run lower, just say below that 6740 region. So equity markets are lower, but there isn't a massive catalytic shift. And you see the VIX is pushing higher. This is a risk-off market, but at the moment, this can just be considered a dip. Now, it could accelerate further, so that's why I personally would only want to enter in, say, the FTSE 100, but I'd have my stops quite tight. Similarly, S&P 500, key support, but I have my stops quite tight. So if this does accelerate further, then you just take the loss, because medium term, the pictures for equities remains to the upside. Very low interest rates, broad fiscal stimulus, all of that should support equity markets. But a lot of analysts have been saying how high equity markets have been. So a pullback is normal, it's healthy, it's part of a normal trend. Is this the correction that's feared? Personally speaking, I don't think this is yet, but we may still see some further downside. An ideal drop lower for me would be the FTSE 100 moving down to that 6500 region would provide a superb area for potentially going long, and that would be really attractive for buying if we got as low down as the 6500 stops at the 6200. But equity markets, global indices lower, volatility higher. We have a clear risk-off market in the bond, in the commodities, in the indices, and now take a look at the currencies, and we can see clear risk-off tones. The high beta commodity-based currencies, Aussie, CAD, New Zealand dollar, all lower. And we're seeing bids into the Japanese yen and the Swiss franc, safe haven flows. We're also seeing bids into the US dollar, most likely to be safe haven flows today. Remember, the dollar has different drivers. Sometimes it acts as a safe haven, and the safe haven bids is the most likely reason for the dollar strength today. But it's quite limited, so I'm not expecting this to carry on through the session. If it does, look at this 92.80 region to hold. If that region doesn't hold, we'd expect a retracement back lower. So markets are very risk off. Now, let me talk you through gold. Now, gold is at a very interesting point at the moment. It's just dropping into that key support area. Now, if we look at real yields, let me show you what drives gold. When real yields fall, that tends to make gold move higher. So when we have real yields falling, we tend to see gold move higher. Now you can see that, like in April, real yields fell, gold has risen. Now look, real yields are falling, but you see gold hasn't risen up to those high levels of May and June. Why? Look at the dollar. The dollar strength has been preventing gold from keep moving higher. That's the main driver to be looking at the moment for gold, is the US dollar. And if the US dollar suddenly retraces, expect gold to move higher. So if the dollar suddenly pulls back lower, take a careful eye on gold, and I'd expect some pretty quick retracement in gold, moving back and rejecting this sort of 1800, 1830 support level that gold's moved back into. Okay, so that's a key level to be looking at. I've got this key trend line marked. Now, when you have trend lines like this that are broken, that are very clear, they're very clean. So one test, two tests, break, broken back through, retest. We can use that trend line to define risk. Stay above, bulls are in charge, get back below, the bears are in charge. So we can use gold. But it's the dollar that's really pushing gold around today. Real yields ultimately drive it, but with the dollar staying firm, it's limiting gold's upside. With these 10-year yields dropping lower, that's fantastic news, should be, for gold. But the firm dollar is keeping gold depressed, even though the inflation is high. So all gold needs is a weak dollar, and then gold upside we could anticipate. So look out for that for gold. Now let's look at the calendar. The main event this week is the ECB monetary policy statement. Now let me explain what's been going on with the ECB. Now the ECB have had a recent strategic review, and in the recent strategic review, what they've been saying is that they want to change their inflation target. Previously, their inflation target was inflation was to be below but close to 2%. They've now changed the inflation target to just 2%. Well, why is that relevant, you might say? Well, what it means is that the ECB are explaining that they want to see inflation at 2%, so they are going to allow inflation to run higher than previously, and they also said they will tolerate higher inflation that's considered to be temporary. So that means the ECB, will they give even more quantitative easing to try to boost inflation? There's a possibility they will do that. So many investors are considering this a potentially bearish development for the ECB. So what will they do on Thursday? Will they? Now they have like 3 tools to help the Eurozone. Tool 1 is interest rates. The lower the better for European stocks and European companies, because borrowing costs are lower. Then they have the pandemic emergency pandemic response program, PEP, and that's 1.850 billion envelope size, but it's due to expire March next year. And they also have the APP purchase program, which is their general asset purchase program. Now that is 20 billion euros a month. So what speculation is rising is that Christine Lagarde has said that we might transfer the emergency PEP program into a different format. So she's hinting that the ECB are looking at giving more support for the Eurozone economy for longer, and they're just going to change the name of the emergency response program. So that is a very bearish development. Now, what that means is that as we look at, say, let's look at the bond yield spread between Eurozone and the US. So this bond yield spread is very helpful for tracking the euro-US dollar. And you can see here there's a bit of a divergence going. Do you see how the bond yield spread, the euro-US dollar tracks it? This is basically the risk profile between German bonds. Now, there isn't a European bond. Germany is the largest country in the Eurozone, so the German bond is considered to be a proxy for the Eurozone. So we've got the bond yield spread between the German 10-year bond and the US 10-year bond. Now, the bond yield spread is a very well traded phenomena. And when you see a divergence like this, you want to pay attention. Now, the divergence is saying that the Eurozone should make a faster recovery than the US. But price is saying the Eurozone is going to make a slower recovery than the US. So one of these is right, one of these is wrong. The ECB meeting could be helpful. Now, if the ECB are more hawkish than the market's expecting, then look for the euro-US dollar to rise. And this could be an excellent position for potentially finding buyers if that level holds today. Okay, so look out for that. It's definitely worth looking for. If that holds, if on Thursday we see a hawkish ECB, then a euro-US dollar buying at market makes sense. Stops can be run just below that trend line, looking for a retest up to 1.2 and then 1.2, 100, 200. There's a lot of potential there, but we need to see a hawkish shift because markets are expecting them to be dovish. We're always looking for what's unexpected in markets. So that ECB currency policy decision is hotly anticipated. Now, there's one other little thing that I need to say about that. On Friday, there's something called a sources report. Now, sources report is the unofficial kind of communication to the market by the ECB. So the sources report will help clarify or prepare the market to kind of know what's coming. And what the sources report said on Friday was that the European Central Bank behind the scenes have been having huge arguments and they couldn't come to any agreement about what to do with the bond purchase program. And as a result, they won't be talking about it this week. So the ECB decision could disappoint investors today, which would lead to a euro-US dollar upside. Now, to factor that in, you also have to remember the dollar. The dollar index, the nickname for the dollar index, is the anti-euro-US dollar. So if you look at the euro-US dollar, and if we just look at the dollar index, you can see very clearly when the dollar index falls, yellow line, euro-US dollar rises. When the dollar index rises, euro-US dollar falls. Yeah, do you see how close that connection is? Dollar index falling, euro-US dollar rising. You can trade the dollar index and the euro-US dollar interchangeably. So what that means is that if you're trading the euro-US dollar, you must also be completely aware of what's happening with the dollar index. So in other words, if there is risk off flows that carry in all week, that's dollar strength. So if the ECB decide to surprise markets, that would be euro. If it's no more hawkish, that would be euro strength, which would mean euro-US dollar will be flat. So make sure you know what's happening with the dollar if you're going to trade the euro-US dollar pair, always. Now, another important data point was New Zealand inflation last week. Came in on Thursday, really important. This New Zealand inflation data, you can see here, this was the highest reading in 19 quarters for New Zealand. So that is like, you know, around 5 years worth of price. It came in at 3.3% the year-on-year reading. This is the quarter-on-quarter reading here, 3.3%, and that is above the 1 to 3% target that the RBNZ has. Now, as a result of this strong inflationary print, remember early in the week, the Reserve Bank of New Zealand met and they gave a hawkish twist and they said that their bond purchase program is going to end early. It's going to end in like 4 days' time on the 23rd of July. A very hawkish shift. Now that is New Zealand dollar positive. So if we see any dollar weakness coming in, this New Zealand dollar is primed for strength and wants to see strength. So dollar weakness, expect this to find buyers at market. You know, if you suddenly get dollar weakness coming in, New Zealand US dollar is a great buy. Inflation rising. The 4 largest investment banks in New Zealand have now upgraded their interest rate hikes, thinking that the RBNZ will hike now in August. That's just next month. So that will be one of the fastest central banks recovering from the COVID-19 immediate crisis. So it's very bullish for the New Zealand dollar. So look for opportunities to buy New Zealand dollar medium term. but look for it against a weak currency. So one perfect currency that I'm looking to sell it against. Now I sold it a little bit against the Aussie New Zealand dollar, but I'm looking for, let's just find this here. But I'm looking for more weakness in this Aussie New Zealand dollar currency pair, because there's a divergence between the Reserve Bank of Australia and the Reserve Bank of New Zealand. Now, any retracement back up to that 1.0650, I consider very suitable for going short. The other option in terms of looking at entering here on this latest leg lower is just that 50% fib retracement level. So just there into 1.0645, you can consider that's suitable for shorting. We've had a temporary trend line broken, pushed back above. We'd expect to find sellers, and those sellers should keep on the Aussie New Zealand dollar pair with a divergence outlook between the two. So medium term, that is one trade that I'm finding interesting. Pound Australian dollar, is this still a good trade longer term? Now, looking at the pound Australian dollar, we've been talking about a pound Australian dollar, buying this for some time with a diverging outlook between the UK and the Reserve Bank of Australia. So if I'm going back here, we can see that been looking at pound Australian dollar strength since 5th of July. And I think I was even before that myself personally, but that's when I really sort of, put the message out. Now, I've been long for a while. Is it still suitable for longs? Not at current market prices, it isn't, because a lot of that run has happened. The only area I'd see as suitable pound Australian dollar would be any retracements lower back to that 1.8500. Now, the diverging outlook is that the UK is recovering so-called freedom day today in the UK, whereas Australia is in more lockdowns. The key difference between the two nations is vaccinations. 50% of the UK at least has been fully vaccinated. Only around 10% of the Australian population has been fully vaccinated. So there is a divergence between the UK on the Australia and the Australia's outlook going forward. That should favour pound Australian dollar buyers. So I'm expecting a move higher, looking at a first target into that 1.8800 region. So that's something to be looking out for this week. The outlook does remain still very much to the upside, and you can just see today that the pressure has just carried on being on the pound Australian dollar, pushing up, trying to break above this very near-term trend line. I am core long the pound Australian dollar, so I would like to see further upside, and I'm holding my take profit area until that 1.8800 region. That's the first area that I consider suitable taking profit. You can see this key overhead resistance support 1.1800 makes sense. So that's what I'm looking at there. And the pound Australian dollar, is it still suitable for longs? Yes, but only from retracements back down to that 1.8500. Don't chase it at these prices. I had someone ask me about that today, and look, I've been talking about this since early July, and that diverging outlook is pushing forward. Okay, and that's what we're expecting. But we don't want to buy at highs. We always want to buy at those pullbacks. You can see that it was very easy to buy against that trend line underneath the 200 moving average, and we had that key pin bar. Big pin bar rejecting the support. So that's the time that I was getting in, around this area, and stops just under that 200 exponential moving average. So I'm looking for this to keep moving higher, but don't get in at these prices extended. Look for these divergences and try to get into them early, ideally before other people have recognized them. That's what you want to be doing. Okay. So now, what do we learn from the Bank of Canada decision? Don't forget, anytime you want to know what's happened to a central bank, go to my blog, blog.hycmlab.com, and go to Central Bank Watch. So I'll just put it in here. I'll put this in the Q&A box. So put this in the chat box here, right? And I go through all the central bank decisions. So this is the last decision, Bank of Canada. They met last week. Basically, you can check this out yourself, but the bottom line is they were much more dovish this time. They were much more neutral. They have been very hawkish. You go back to like April, they surprised markets with a huge shift here in April. Let's have a look. Here it is. This April meeting there, they just surprised markets and they basically said, okay, we are going to taper bond purchases, and no one saw it coming. And that just resulted in 500 points of CAD strength. Then there was just a retracement, but then we had the June FOMC dot plot shift here when the Fed said that they see earlier interest rate hikes. And now the fact we have two things that have really pushed the US dollar CAD higher today is basically being that very weak oil. So as oil's weakened, that's pushed the US dollar CAD higher because CAD's weakened, and we've had positive inflows on risk, with the risk-off flows seeing the dollar bid and the Canadian dollar seeing falls. So from an intraday trading perspective, if you like to day trade, then like the obvious place to enter, let's just have a look. Let me just find an obvious place to enter. It's a bit trickier with markets being so extended. Let me add a few pivot points on here. Yeah, anyone back down to that R2 level would be suitable, around that 1.2660 region. So that would be an ideal area. Okay, folks, the key thing to be looking out for today is just keeping an eye on volatility to make sure that doesn't keep going higher. There's no reason for these equity markets falling like they are, aside from, you know, is it rising COVID cases? I don't think so. I think the vaccine is still keeping things under control. Is it US-China tensions? We've known about those for quite some time. It strikes me more as a natural pullback, which is what you expected in markets. So there's nothing there that's particularly a shock or a surprise. But nevertheless, keep your eye on it. If it does accelerate, watch out, obviously. And if you are going to enter into these markets, just be nimble, you know, and enter in obvious places of support and resistance. What you want to avoid doing is buying up at these highs, you know, and then having to sit through months or weeks of drawdown. Okay, so just use the key technicals to enter your positions and be very careful of using leverage. That is the main issues. The only other thing to look at is obviously German PMI data is coming in at the end of the week. Now, if we see a strong recovery in Germany, that will bode well for the Eurozone, okay? So remember, these PMIs come out in order. You have the French, the German, then you have the overall Eurozone reading. But remember, the move happens on the French and the German reading. So as these come out, the market moves. By the time the European results are out, people really know what's happening, because, you know, Germany and France, particularly Germany, is considered to be the, you know, the powerhouse of Europe. So watch out for that on Friday, and remember to read that PMI data in light of the ECB meeting. So as if the ECB meeting are more neutral, and they're like kind of like saying, well, we're going to see how the recovery goes, and then the recovery looks like it's going great out of Germany, that'll be Euro strength. And vice versa, you know, if they say, oh, it's really bad, we're not sure, we're disappointed, you know, rising COVID-19 cases, doom and gloom, and then the German data is poor, then that's more like the Euro weakness. Okay, folks, that is the main issues. There's the Aussie monetary policy meeting minutes. That could have an impact. The main driver of the Aussie at the moment is the rising COVID-19 cases and low vaccination rates in the RBA in Australia, which should be a real drag. Okay, folks, I hope that's a help. That's the main issues to be looking at. Okay. If you've got any questions, please do put them in the Q&A box. Remember, the only silly question is the question that you don't ask. Markets are in a funny mood at the moment. This relentless bid into bonds. I will just close by saying this. Remember that this bid into bonds at the start of the year, this selling of bonds, which is why the bond yields rose, was because the market was expecting the US to normalize. Now, you've got to ask yourself, where is the US 10-year bond yield going to be in 6 months' time? Like virtually all of the analysts interviewed by Reuters think that it's more likely that 10-year yields can be closer to 2 than it is to be like 1 and below. Okay, so everyone's expecting these yields to move higher. Now, a lot of people say, well, why aren't they? Why aren't they? Is it rising? Is it the fact that we'll never be shot of COVID? Now, for me, I don't see that reason. I think the Fed will normalize. I think it'll only take them one good jobs report, and then I think Jerome Powell will shift. He keeps saying, you know, transitory inflation, not worry, we need to see sufficient signs of progress. I think as soon as you get one good jobs report with a good participation rate, with numbers back to pre-COVID-19 levels, I think that'll be it. And I think the dollar will roar and these 10-year yields will pick up. So the best opportunity that I can see to get ready for is US dollar Japanese yen long. Now remember, this pair tracks the US 10-year yields very, very closely. So you can see here that, you know, when 10-year yields rise, just show you here, go to the daily chart. So, you know, 10-year yields rise, US dollar yen rises with it. When the 10-year yields fall, US dollar Japanese yen falls with it. 10-year yields falling, US dollar Japanese yen falling. So a rise in the US 10-year yields will boost the US dollar yen. So as soon as we think that turning point is reached, dollar yen upside looks very good. Bank of Japan met last week. They're not doing anything. They're going to be very bearish for a long, long time to come. You know, there's a lot of medium-term, you know, US dollar, Japanese yen weakness that I can see over the next kind of, you know, 6 to 12 months. We've got this break to the upside. Any retracement down to that 108, 108.50 region, I think it's a great level to go long. So from a medium-term perspective, that's a great level. Stay above, bulls are in charge. Get back below. You can always cut the trade and look to rejoin if we push above it. But medium-term trade, that's what I really like with the dollar yen. It's one I'm sort of, you know, it's on my watch list. And I'll be keeping careful eye on the US 10-year yields. Okay, folks, it's a pleasure as always. I hope you have an excellent trading week, and I look forward to being in touch with you soon. Thank you now. Goodbye.